Chapter 1, Banks. This is the first chapter in your book 3 for FRM part 1. We're going to cover this chapter in 3 videos. The first video is going to cover the first two contents that you see over here, which is the risks in banking and banking regulation. Then we will move on to cover deposit insurance and investment banking. And in the last video, we're going to cover conflicts of interest and the originate to distribute model. Let's get started. So, banks are, of course, the foundation of the world's financial system, and they can be categorized broadly into commercial banks and investment banks. Commercial banks take deposits and they make loans. This is the normal type of bank that you see on the high street. Many commercial banks are actually doing both retail banking and wholesale banking. Retail banking means taking deposits from individuals and giving loans to small businesses, and also giving loans to individuals and taking deposits from small businesses, primarily dealing with smaller individual customers. Whereas wholesale banking is taking very, very large deposits and giving out very large loans, usually from and to large corporations. Now, in many commercial banks, we see that they have departments for both retail banking and wholesale banking. But also, what we have seen is that some banks are just primarily doing retail banking, while some are only doing wholesale banking. Now, investment banking is altogether a different type of business. Here, what happens is companies who want to not get a loan from a bank, but rather they want to maybe issue their own bonds. The objective might be to either raise a lot more money than they would be able to get from a loan from a bank, or maybe they would want to raise debt or issue bonds because the rate they will be paying to bondholders will be lower than what they would have otherwise had to pay to the bank if they were getting a loan from the bank. And just for your clarity of understanding, why that is possible is because usually if you have a bank in the middle and the depositor is coming from here and the company is getting a loan from the bank, giving an interest to the bank, then the bank keeps a net interest margin before paying the saving rate to the depositor. However, if the company directly issues bonds to the investor and gets money from the investor, then they save this net interest margin which the bank would otherwise keep, and thereby the investor will be able to get a higher rate and the company will be able to actually pay a lower rate. Let me give you an example. So let's say in this current situation, the investor is getting 3% and the company is paying 5% to the bank. Now, maybe both of them will be happier if they directly issue the bonds at 4%. So this way the investor gets 4% and the company pays 4%. So lower for the company, higher for the investor. You just take out the intermediary from the middle. So that is where raising debt would come in, that the company would raise bonds, pay a lower rate than what it is paying on a loan to from a bank, and yet the investor would actually get a higher percentage. Also, there is a limit to the amount of loans or debt you can get as a company. So maybe they want to now increase the equity capital that they have, so they might go for an IPO, which is an example of raising equity capital for companies. Investment banks help out in a lot of other type of transactions as well, such as mergers, acquisitions, and other type of financing decisions, deciding whether to go for debt or equity, and if debt then how, and if equity then how, and if at what price should you sell your shares, how many shares should you sell. They even act as a broker slash dealer for trading debt, equity, and other securities. So let's say there is a company interested in selling some of their debt, or there is an investor who already holds some bonds of another company and would like to sell them. So the investment bank might be able to help them find a buyer for their current holding. So these are the two broad categories of banks. Moving on. So, why is all this important? Because we need to keep the financial system stable, and banks, as I just mentioned, are the main foundation of the financial system. So, we have to treat both of these, commercial banking and investment banking, separately, because the deposits that the commercial banks are taking are of a completely different nature. Think about the money that you're putting in your local bank, right? That is not an investment bank, that is a commercial bank, and you would not expect one day to wake up and hear that, oh, sorry, your deposit is not available anymore because the bank invested it somewhere and they had a loss, right? That is obviously something which you will not accept. Investment banking, of course, on the other hand, doesn't take deposits like that. They are into more specialized activities. So therefore, we need to be able to have a separation. And in many countries, it's written some over here, but I think in most developed countries, what we have now is that investment banks are not allowed to take deposits and make loans. Their business is separate. In the US, we've had this sort of love-hate relationship with this concept that initially they were allowed, but then they were not allowed, and then again they got allowed in the middle, and then now again they're not allowed. But what we have seen over the years, and I'm talking about over the past 100 years, is that this is something very, very serious, and investment banks should not be allowed to do the same business as commercial banks, especially take the deposits as commercial banks, because those deposits are very, very risk averse. They are not to be used for risky activities. And at the same time, commercial banks should not be allowed to get into the business of investment banking. We need to treat these two separately. It is very important for the safety and health of the financial system. Now, what are the three main risks that banks face? In your curriculum, these are the three main risks written, and they talk about liquidity separately. But what I would do is I would highly recommend that you always think of four risks when you talk about or when you think about banks, because especially since the 2008 financial crisis, what we saw was that the problem was not market risk or credit risk or operational risk. It was primarily liquidity risk. And this topic is covered in your curriculum, and even covered in the slides, as you will see when we get to the liquidity risk part, but it is not listed as the one of the three main risks. However, I would like you to develop your mental map based on four main risks that banks face. And the first one is actually credit risks. So, when Basel framework started, Basel 1, this is the main one that they brought in first. And this is still, of course, the biggest risk that banks face, because their core business is to give out loans. And those loans are ideally given to credit worthy parties, credible parties, but they can default, right? So if they do default, then the bank will lose that money. So the main risk, the main risk that banks face is credit risk. Then next, what Basel updated was market risks. That hey, banks are not only giving out loans, they are also making investments in stocks, in bonds, which are exposed to the fluctuations in the market. Therefore, banks are also facing market risk. And then what we saw later on in the Basel amendments and the updations is that they also brought in operational risk, which is related to internal and external factors, and we will look at both, right? Mostly what you're looking at over here is human error, fraud, or natural calamities with respect to external, and fraud and human error with respect to internal. But what I would like you to also do is that put in your mind that there is a fourth main risk, and that is liquidity risk. And what happens is that from your bank's asset liability committee perspective, as some of you might know, that the higher the maturity of a loan or an investment, the higher the interest rate or the profit you can get or the yield you can get from that investment if the yield curve is upward sloping, which it usually is. So, what they would want to do is they would want to invest their assets at higher maturity to get higher rates, but they would want to pay lower yield on their liabilities, so they would want lower maturity on their liabilities. And if you will go for this type of approach to maximize your profitability, what will happen is that there is going to be a mismatch between your assets and liability maturity, which will lead to a liquidity risk. Because if this liability matures and you pay out all that money and your assets are actually not maturing, so you haven't gotten the cash, so you're going to get into a liquidity crisis. So please don't underestimate the importance of liquidity crisis. It is covered in your curriculum. We are going to talk about it, especially the uh, net stable funding ratio and the 30-day stress test, where we are going to check if the bank has enough money if they had to pay their liabilities for 30 days, number one. And number two, the net stable funding ratio is about checking the maturity matching between your assets and liabilities. Anyways, now let's talk about each one of them separately. As I told you, market risk is related to the markets going up and down. So we are talking about movements in market variables. And what are these variables? Exchange rates with respect to foreign currencies, interest rates, and this is very, very important for bonds. It's also very important for stocks, but bonds are very, very sensitive to movements in the interest rate. If the interest rate is going to go up, your bond prices are going to come down. And banks have a lot of significant investments in bonds. Even though those bonds might be mainly in government bonds, those investments might be mainly in government bonds, which don't have credit risk because the government, of course, can print money and give the payment back to you, but they will have market risk because if interest rates will go up, the government bonds will even come down. And naturally, stock market goes up and down for a lot of various systemic reasons which are included in market risk, such as inflation, labor market either getting too tight or vice versa, or you can have GDP growth slowing down, or maybe even a recession. So a lot of factors impact your stock prices. Now, what happens is that the bank might have $100, let's say, in deposit, just keeping it simple. Part of that will be given into loans, what we usually call advances, right? And then part of that might be investments. So these investments are going to be done based on the bank's trading operations. And because of that, what is the exposure that you're going to get? That is known as market risk. And these securities which the bank is investing in might decline in value due to unfavorable movements in market variables such as exchange rates, interest rates, equity prices, and so forth. Banks are also making the market. So, how does that create an exposure? So when you're a market maker, you're actually taking the opposite side of that trade. So let's say, for example, there's a corporate client coming in and you're giving them, as the bank, you're giving them either a currency forward or a commodity forward. And you're not just giving this product to them and getting another buyer or seller on the other side. You're actually taking the other side yourself, which means you're the market maker for this product. Which means you've got exposure, right? You've got market exposure since you've taken the other side of that contract. Now you can hedge by taking the opposite side back to back by with another client or with another financial institution, just to make sure that the risk is hedged. But what we have seen, and I have practically seen this as well, is that sometimes we don't completely hedge. We on purpose leave some exposure unhedged So we do not completely eliminate this exposure, and the reason for that is because we actually take some exposure because we think we can make a profit on those. But as you know, no return comes without risk. So banks are actually exposing themselves by design, by conscious decision to some market risk in order to make some return, as they are of course exposing themselves to credit risk by design. That is their core business, right? So when they are making loans to borrowers, they know that some of the borrowers may not repay their loans, but that is a risk they are willing to take because not all borrowers are expected to default. A certain percentage are expected to default, and even if that percentage does default, you still make a positive net interest margin. And all of this you're going to learn in terms of expected losses, right? Let me just give you a preview into that. So an expected loss will is calculated based on a probability of default. So you're going to learn about probability of default, which is multiplied by something called loss given default. That even if somebody does default, if a borrower does default, it's not like 100% of that loan will not be recovered. You might have some collateral which you might be able to liquidate. So loss given default says how much loss will be there given that the default has happened, for number one. Number two, of course, there's a limited probability of that happening as well, and of course this is multiplied by the exposure amount in terms of what is the nominal amount of the loan. Anyways, you will get into that calculation later on in a different video, but what is important for you to understand that this is expected. This is part of the normal operations, and you need to build this into the interest rate that you are charging. And let me give you an example. So let's say a bank is charging 4% to borrowers on their loans, and the cost of that money which they have to pay to the depositors is 1.5%. So the net interest margin will be 4 minus 1.5, which is 2.5. Now let's say 0.8% of the loans are going to default, right? So what you will have left with from your net interest margin of 2.5 minus 0.8, you're going to be left with 1.7%, and this is going to be your income to cover your operating costs and then contribute towards profits. So this is how commercial banking works. What banks do now is also trade derivatives. Now, what happens with derivatives, that there is counterparty risk, and you're going to learn about this more in FRM part 2. This is relatively a more complicated calculation, but primarily what is happening over here, that you've got bank A and let's say you've got bank B, and they are getting into a derivative contract. Now, the thing with a derivative contract is that it could be in profit for either party, and it could be a loss for one party and profit for the other party. But we don't know which party is going to be in profit and which party is going to be in loss until the contract is moving towards closing, because at initiation these contracts are usually having a value of 0. It is only later on that we realize that which party is going to be in profit and which party is going to be in loss, and the party that is in profit obviously would like the party in loss to make the payment to them, but the party in loss might not. Usually, of course, we don't see that this happens, but that possibility is there. And this is what happened with Lehman Brothers in the 2008, that because Lehman Brothers was just not able to continue as a business, even if they wanted, they could not make the payments, or they could not make good on their commitments, and therefore all the other parties that were to receive profit from Lehman Brothers faced counterparty risk. So you also have to understand that when we talk about credit risk, it's not only your borrowers defaulting, it is also the financial institutions that you're doing derivative trades with could also default, right? So that is a type of credit risk, but you will learn more about this in FRM part 2. Now moving to operational risks. They can be categorized into internal, failed internal controls, or from external events. So let's have a look at each separately. Let's look at internal controls first. This could be your traders going rogue, and some very, very interesting examples. I believe one of the very famous stories here is the Niam Leeson story from the Barings Bank. So it was a very significantly large bank, and just one trader actually made the whole bank collapse. So this could be very, very serious as well. You could also have some IT oriented failures, so kind of cyber risk, but this is an internal cyber risk. There is also a external cyber risk that we will talk about. And again, cyber risk, another example where you can have fat fingers data entry errors, right? So this is all internal controls. If the intention is bad, then it is a rogue trader, or if the intention is not bad, it's just a mistake, then it could be a data entry error or maybe a hardware and software failure. Now, when we talk about external events, you could have cyber attacks, and very, very common these days, what we are seeing is a lot of ransomware where they control your computers and they hold your computers hostage and ask for ransom. Difficult situation to be in. Bank robberies, the traditional type of external event that a bank would face, but now more and more what we are seeing is the cyber version of such activities. Then you could also have natural calamities, God forbid, right? And that could cause a lot of damage to your physical assets. Another way to categorize operational risks is whether internal or external. You can categorize into cyber risks, which could have internal ramifications, or external. So, for example, if your hardware and software is failing, that is an example of internal cyber risk. If you're getting a ransomware attack, that is external cyber risk. Legal risk, anything related to your regulation, or anything related to maybe a customer slipping in one of your branches. And then compliance risk is that you are not able to actually maintain your required activities based on your regulations, and therefore you face a fine. So operational risks are usually looked at in terms of the income you are getting from different business divisions, business lines. And then what we do is we actually see which business lines are having more risk. So we actually keep a bigger buffer for those. But you will learn more about this in book 4, how to actually calculate the capital to protect against operational risks. Now, let's move into bank regulation, which will give us a basic understanding of capital requirements. And then in book 4, you're actually going to learn how to calculate how much capital is required. So, what the regulator does is that it says, hey, you have to protect the people who have deposited money in your banks, right? So that they are not afraid and they have a certain confidence in the stability of the financial system. Now, how do they do that? So, let's say there is a bank, right? And that bank has a lot of depositors coming in and putting money into this bank. So let's say they've got $10 billion in this bank. Now you need to have a certain amount of capital of your own, right, to protect this capital from losses. So let's say this can be $1 billion. Now, how much should this be? The amount is what we are going to learn in book 4 how to calculate, but we're just going to discuss the basics of what this capital is, and how there are two versions of this, which is the regulatory and the economic. And it serves the purpose of absorbing losses. So let's say there are losses, and those losses, before they can get to the depositors, should be absorbed by your your bank's own capital. And the bank can even have part of this can be equity and part of this can be debt. So the debt will also actually take the hit before the depositor's money is going to be touched. So let's talk about capital. Of course, equity capital is the most important for the bank. They must maintain sufficient capital to cover the risks they are taking. And equity capital should be enough to cover potential losses. How much that should be is covered in book 4. We'll learn how to calculate. But it should be enough to cover potential losses so that the bank remains solvent. However, if the bank is unable to remain solvent, then the next type of capital that takes a hit is your long term debt, the bonds which the bank has issued, and the investors in those bonds will take the hit next after equity capital is wiped out. And therefore, this debt is subordinated to the claims of the depositor. So it provides an extra degree of protection to the depositors. Theoretically, the depositors, of course, will be at risk when both equity and debt capital is wiped out. Now, as long as the bank is a going concern, the equity capital will be there. The minute the equity capital is completely wiped out, then it will be known as a gone concern, and that is when it is going to be bankrupt, and the debt capital will be used to absorb the losses. This is obviously only done when the bank goes out of business, and once that happens, then your depositor's money is at risk. So, of course, from a regulator's perspective, we have to make sure that equity and debt capital, especially equity capital, is enough to absorb the expected losses and even the unexpected, a portion of unexpected losses. What is the difference between regulatory capital and economic capital? So, regulatory capital is what is the minimum required. So, what you're going to learn in book 4 is how to calculate the regulatory capital, but majority of the banks, they don't just maintain regulatory capital. This is the minimum required by the regulators. What good banks would do is they would maintain more than that, which is known as economic capital, and this is based on the estimate which is calculated using the bank's own models. So, which could be more, but it definitely cannot be less than the regulatory capital because this is the minimum that is required. Of course, the concept is to set funds aside to absorb unexpected losses, expected and unexpected losses. Naturally, expected losses get provisioned, so your capital is obviously getting a hit from that provision, anyways. So, what you need to have is additional capital to take care of the unexpected losses which could be there. How much depends on the size of potential losses, and again, we will look at that in book 4. So, how does the regulation for this happen? Luckily, we have global sort of coordination going on. This is something we're still trying to achieve for insurance companies, and it's almost there. But luckily for banks, we already have this global coordination where there is a standardization, and that is coming from a place in Switzerland called Basel, where there is a meeting of banks, and that is the Basel Committee. Started in 1974. Initially, they only talked about credit risk, and then later they realized that, oh, we also have market risk, and then they also realized, oh, we have operational risk as well. So that has been added, and as I have been telling you, that now we also, since the 2008 financial crisis, we also have a very serious realization that liquidity risk is also a serious concern. So, initially, what the Basel Committee allowed was that you could use your own models, but now, after facing so many issues, what has happened is that there are now standardized models which need to be used, right? And especially after the 2008 financial crisis, the Basel Committee decided to reduce the use of internal model, and now all three risks, which is credit, market, and operational risk, must be computed using standardized models. So how that works is that you can use your own model as well. and whatever is the amount of capital you think you need to keep for market risk and credit risk based on your internal model, it you can do that, right, as long as it is not less than the minimum required. So here, don't get sort of confused with this formula. It's a very simple thing that is being stated over here, that maximum of either your IMC, which is computed through your internal model, or 0.725 or 72.5% of what your standardized model is saying. So, whichever is more. And this 72.5% is going to come in force by 2027. So this is an important concept. Also, we have to be able to distinguish between trading book versus banking book. Now, those of you who have an accounting background might appreciate the difference between holding till maturity, certain securities which we are investing in and we intend to hold them till maturity, versus held for trading or available for sale. So, what happens is that if you're buying certain securities with the intention of trading, then you are required to hold them on your books at fair value or market value, which means they will be subject to market risk because they will be going up and down and you will be updating the value that you have on your books. Which is a good thing from a regulatory perspective, because at least it will reflect an accurate picture of what those assets are worth, right? But you as a bank can have a banking book, and by default whatever assets you buy are shown on the banking book, which assumes that they will be held to maturity, therefore are not subject to market risk, because since you're not planning on selling them before maturity, you are holding them till maturity and you will get the face value back at maturity. And we're talking mostly about bonds over here. So the only risk that is of major concern here is that that company or that government to who you have lent the money in terms of buying the bonds might default. So primarily what we're looking at over here is credit risk and not market risk. But then from a regulatory perspective, the capital requirement will be higher for the banking book since you are not marking them to market, which means since you are not taking the market fluctuations and taking that impact on your books, you will have to have a higher regulatory capital to offset for potential losses in the future. By default, all instruments are considered part of the banking book. However, if you do have a trading desk, then you can classify them as your trading book. Of course, I've been talking about liquidity risk, and since the 2008 financial crisis, what we have seen is that it was caused primarily because of a lack of liquidity instead of a shortage of capital. So now what the Basel committee has done is that it has added two very important ratios, and there is absolutely no compromise on this. This has to be met. Number one is the liquidity coverage ratio, that the bank has to have sufficient funding sources to survive a 30-day period of acute stress. And number two, the net stable funding ratio, that you need to have a maturity matching in your assets and liabilities. So guys, that is it for this video, and in the next one we're going to move to deposit insurance. Thank you for watching.